And the next thing is understanding market structure and what how the price action looks in as a whole, and understanding into like how to interpret it and identify like what's actually happening in the market and understanding different trends. So, all right. So yeah, market structure, identifying trends. You've been exposed to it already. Support, resistance, supply and demand. Those are the key components of market structure, and understanding the core behind market structure is honestly like the hardest thing. And it's just really important to understand market structure so you can make better decisions. That's all I'm gonna say. So bullish market structure that exhibits higher highs and higher lows. So price moves higher, and then price isn't gonna move up infinitely. It has to come back down. Supply is gonna come in, stuff like that. But over time, like you see that price keeps moving higher, and each time there's like a pullback. So it moves up, pulls back, creates a higher low, and then it moves higher again. So it's a higher high. So it's higher than the previous high, right? And then this low is higher than the previous low. And this low is higher than the previous low. And this high is higher than the previous high. So that's bullish market structure. And it indicates an overall upward trend in stock prices, reflecting a constant increase in buyers' willingness to pay more for the stock over time. And each new high is higher than the previous one. Each new low is higher than the previous low. And that just means that is increasing demand, increasing enthusiasm among buyers because they're willing to purchase the stock or whatever you're trading at progressively higher prices because they expect that the trends are going to continue higher, or they have enough demand for it. And the higher lows suggest that even though there is still selling, price is always going to sell, people are going to take profit, things are going to pull back. Buyers are still stepping in because there's not enough of a surplus of supply to keep pushing prices down, and there's more demand than there is supply. So no matter what, price keeps going up higher. And yeah, pattern of higher highs and higher lows reflect increasing demand. Market participants become more optimistic about the stock's future value. They're willing to buy at higher prices. And while the demand increases, there isn't enough supply to feed that increasing surplus of demand, and that causes the price to increase because that's just the relationship between supply and demand. Because there pretty much is like this. There isn't enough of something, so it's gonna cost more for you to get it. Like it's more valuable in a way. So like, I mean, I don't need to give you an example. You understand it. I've talked about it so much already. So now we have bearish market structure. It's the obviously the opposite of bullish market structure, and that just lower highs and lower lows. Every time price makes a high, it's lower than the previous high, and that shows that it's bearish because price is over the long term going down. It's trending downwards. So, bearish market structure categorized by general downward trend in the price of a stock. This downtrend is marked by a series of lower highs and lower lows, indicating declining buyer interest and increasing selling pressure on the specific stock. So in a bearish market, each new high lower than the previous high, lower than the previous high, and each new low lower than the previous low. And from a supply and demand perspective, um, pattern of lower highs and lower lows signals diminishing demand and increasing surplus of supply. Um, Whether it means investors are losing confidence in the stock, or for whatever reason, there's some kind of catalyst that's causing price to go lower and causing less demand, less people wanting to buy and spend their money and buy stock or whatever. It doesn't really matter in terms of technical analysis. As long as you see this on the chart, that means there's a surplus of supply and we're in a downtrend. And it obviously signals negative sentiment, and prices declining and leading to, and as it's kind of like snowball effect. If prices keep going up, it leads to more buying. If prices keep going down, it leads to more selling. And that's where, like, you probably have heard like fear, greed, stuff like that. That's us as humans reacting to supply and demand and the interactions between supply and demand. As traders, we would use bullish market structure to help us make decisions on where to buy, when to buy, help us with timing, and it'll give us context and key information to guide how we take the next trade. And that's why market structure is important. And same thing with bearish market structure. As traders, we would use a bearish market structure to indicate whether to exit our long positions or find opportunities to bet on a stock going short and bet on the declines. And or it could just be as a way to like indicate, all right, I'm not going to participate right now because price has the potential to go lower, so I can get in at a better price when stuff starts to shift. There's a lot of ways to use market structure to your advantage. You just have to know how to read it and how to recognize it. And then we have sideways market structure or consolidation. And honestly, sideways market structure kind of, how I talked about doji candles and indecision? That's kind of the same thing with like sideways market structure. The forces of supply and the forces of demand are kind of balanced. Nothing completely outweighs the other. So, you have you have the support level and then you have the resistance level, and price is just trading in between it. The forces are kind of balanced. There's not enough of an imbalance on either side, for price to keep moving up or for price to keep moving down. And that's shown with equal highs and equal lows, or like near equal highs and equal lows. And it just represents a period of equilibrium or balance where the forces are evenly matched. And they're not like staircase patterns in that you would see in like a bullish or bearish market. It's kind of like flat, horizontal, sideways movement. Like it's just up and down, up and down, up and down. It's not, it's within a narrow range, and it's like a channel-like experience or appearance. My bad. And yeah, I touched on it already. It's just demand buy the asset at lower prices. It's matched by the supply or willingness to sell at a higher price, and the balance keeps price confined within a certain range, just trading up and down. And most traditional like trading education, they'll talk about trading the trend, right? So if you're in a bullish market structure, only go long. If you're in a bearish market structure, only go short. If you're in this kind of market structure, either maybe you stay away, or when we're at a support level, you only go long. You don't, or when you're at a resistance level, you go short because, the supply and demand forces are kind of even, so it'll just go up and down, up and down. You're capitalizing on those movements. And, consolidation sometimes is a little tricky to recognize in comparison to the other two, just because it's easy to kind of put your own bias and be like, okay, like you might have your own emotions or certain feelings about the stock that you're in. So even if we're in this kind of structure, you say, oh, like Tesla, they're an amazing company, so they're only going to keep going up. And we could be in this kind of market structure, right? So we had already had equal highs and equal lows, and then we're reaching another equal high again. And you're like, all right, I'm going to go long up here because Tesla's going to keep going up. But there's a resistance and there's a supply up here, and then we just come back down. So like it'd be more strategic in this kind of market structure to buy at a support and sell at a resistance. And again, that's kind of the same concept no matter what. But again, it's just market structure is important to understand how you're gonna kind of, what's the word? Like you want to use market structure to gauge how you're gonna take a specific trade and kind of dictate how you're gonna create your trading plans. Yeah, and understanding this structure is essential for traders to adjust their strategies because it signifies a clear, the market lacking a clear trend, and a lot of times it'll precede the formation of a new trend. So it's kind of like I told you, a doji, it represents indecision before something new happens in the market. And this is an example of how it actually looks in real trading. So, price comes up and then we form a channel of support and resistance. You got the equal lows, equal low, equal low, equal low, and equal high, and equal high, and equal high. You know, price is just channeling between this level of support and resistance, right? But here's where you use the context of, the concept of equal highs, higher lows, lower lows, to see when things are shifting. So, you know, like this is where you really start getting deep into market structure, and you can start seeing the shift in real time of the sentiment and the different things happening in the market. So, right now this is a consolidation action right here. It's just equal highs and equal lows. Like price keeps going up and coming back down. But every single time we would either go up higher, it'd come back down and retouch the support. But look at this now. Like the sentiment started changing. It started seeing more demand enter into the market. So despite you having these equal highs up here, now we're forming a higher low right here and then another higher low up here. So like you can say, so this, like this right here, equal low, equal high, right? Based off of the previous market structure from before. So I'm going to draw a line in between this. So you have this market structure right here where it's consolidation, right? Supply and demand forces are balanced. Now, you might have the same amount of supply, but now we start seeing, okay, there's more demand coming in. So price isn't able to go as low as it did previously because there's more demand. So we have a higher low now. And then we touch this equal high again because supply is still there. So we start rejecting, but we don't reject as hard as we did before because, again, there's more demand. So we form another higher low. And I told you about breakouts, how breakouts represent a shift in supply and demand, and it's such a strong shift where supply and demand will like exceed one or the other, and in this case demand completely like outweighed supply. So we got that breakout, and then price just keeps moving up because there's just so much demand and no supply, so price just keeps going higher and higher. Nobody's really selling anything. And like, yes, we have these red candles, so in those like little periods of candlesticks or time frames, all right, yes, there's going to be selling, but that just goes back to the bullish market structure I told you about, where you got pullbacks. So you got the higher highs and the higher lows. So like this is where straight buying, and then there's little periods of selling in the pullbacks, but there's not enough selling to go lower. It creates a higher low, and then like that's the concept behind it. And these are all just different examples right here. And I chose this example right here. I chose for you because it shows all the market structures all at once, right? So this is kind of like a period of consolidation, but it's bearish consolidation. It's not super strong. It's not like aggressively going down, but there's still more supply than there is demand. So price is going lower over time, and that's how you signify a downtrend. Because look at this right here, right? Lower highs, lower lows, lower highs, lower lows. Kind of the same kind of look pattern. So lower high, lower low, lower high, lower low, lower low. And then all of a sudden we come above that. Now we make a higher low, right? And then a higher high. And then we keep making new highs and new lows. And now this is a whole new market structure right here. So after making this lower low, we turn and start forming an uptrend. Like after we hit here, I guess for whatever reason, demand started coming in, and prices kept going higher and higher and higher and higher. So now, like, look at this: higher low, higher low, higher high, higher high. It has that kind of structure now. And then this is just another example of like how you need to pay attention to the overwhelming and like the strongest context, but you still have to see like, all right, this is how you're going to read this chart. So you have just overall, you have a downtrend with lower highs, right? And it's making lower lows. So overall price is going down lower. And then it starts getting really aggressive. We make a lower low down here, but then we get, look at this, right? Wide body red candles, and then we have hammer candle formations down here, paired with volume. But that's for a later section. I won't, it's a sneak peek. But paired with volume, right? And then wide body candles and hammer candles showing us, all right, demand is starting to step in. So we have demand stepping in, but keep in mind, we're still overall in a downtrend, right? But in that downtrend, things are kind of starting to shift here and there. So you have this lower low, and then all of a sudden, like it makes a lower low here, and then now we have a higher low. And then again, price rallies, make another lower high, but we make another higher low right here. Then we kind of make another lower high. So it shows that, okay, demand is coming in, but in the grand scheme of things, it's not enough to break this overwhelming piece of context, this overwhelming piece of information of supply. So you need to be paying attention to all of those things. So say you went long down here, this is enough. You can capitalize off of this and make money, right? But you wouldn't be able to say, all right, price is going to keep going up until we break this structure of lower highs. So say we have these lower highs and we never break the structure, we're still in a downtrend, no matter what. We're still in a downtrend despite there being demand starting to show up in down here. What you would want to see, if you want to say, all right, I want to buy Tesla, and I want price to keep going up. If you're going to make that kind of decision, you need to see information like this, right? So we have the higher lows, the higher low, a lower high. Say we made another higher low right here, right? And then we came above this high, and we made a higher high. Then you could be like, oh, now supply and demand has shifted. Demand over exceeds supply, and now I can say, all right, we have the potential of going even higher now. But based off of this context right here of lower highs and bearish market structure, it makes more sense to make bearish plans off of these things, off of on this trade, right, or on this stock. And that's how you want to be reading the market. You want to look at the individual candles and see, all right, this is what's happening. These are, specific pieces of information, but you have, this structure is showing me what to do in the grand scheme of things. And yeah, it's just piecing all of those little tools and information in order to create a story. And pretty much with that's market structure. And now we're just gonna move on to section 4, introduction to options. All right, let's go on. I want to show you live real examples on Webull. So this is the same chart that I was showing you, Tesla. I draw the trend line, right? So draw the trend line. Oh, let me go on the weekly chart. So yeah, the overall trend is lower, and then this is a resistance because we have those areas, whatever, you get the point. So yeah, we have, this is the same Tesla, this is the same example that I was showing you on that screenshot, but now we're on the actual stock, right? So this is the weekly time frame, and we had this resistance level. So that shows that, all right, supply, surplus of supply up here. Every time price comes up, and you can see with these wicks that price always comes back down. And I told you about how resistance, or just finding a level, needs to have multiple confluences and confirmation. So look how many times we touch this level and reject it. And because we're in a downtrend, that's how you can also make predictions on what's going to happen, because you have these 3 levels down here, right? So let's assume there was nothing on this side of the chart, and price kept going down, and then price came back up. Like, oh, I saw that we rejected 3 times up here and we formed a downtrend. I can extend that line all the way down into pretty much there's nothing on the chart. We haven't traded those days yet, and I can make the guess that we might reject on those levels again. And I mean, you could see that that's true, right? Yeah, I mean, basically that's it. And let's like mark up another chart, right? So let me find you a good one. This is SPY, right? This is another example that I showed you. So I'm gonna draw a box over this. This is that period of consolidation, where things are kind of indecisive. Price just goes up and down. Let me do this. Price is going up and down, and then we eventually break out. And you break out, consolidate, break out. Because the thing about trends is that you're never going to continue that same kind of strength all the way. Prices always needs to take a break. But overall, we have those periods of higher, this is the market structure. Higher lows, higher highs. It keeps going up. And just that's about it. You just want to keep marking up the chart, marking up charts and looking at different examples of how those concepts that I showed you actually show up in the real market. And